This rule made him billions. Imagine a rule so simple, yet so powerful, that following it consistently could change the course of your financial future forever. For Warren Buffett, this rule has been the foundation of his success, a guiding principle that allowed him to transform a small investment portfolio into a multi-billion-dollar empire. It's not a secret formula, a high-risk strategy, or insider information. It's a mindset, a principle of discipline, patience, and value that he has followed for decades. Buffett's famous rule, often cited in his interviews and letters to shareholders, is simple: never lose money. Rule no one, never lose money. Rule no two, never forget rule no one. At first glance, it might sound obvious, even repetitive. But when you dive deeper, you realize that this rule is far more profound than it seems. It's about how to approach risk, how to make decisions, and how to think long-term, both in investing and in life. From his early days in Omaha, Buffett's discipline was evident. He studied financial statements, learned about businesses in detail, and avoided investments he didn't understand. While other young investors were chasing trends, hot tips, or get-rich-quick opportunities, Buffett focused on minimizing losses. Every investment decision was filtered through this rule. He asked himself, what is the worst that could happen? What is the margin of safety? And only if the answer satisfied him would he proceed. This rule is deceptively simple because most people ignore it. In a world driven by greed and speculation, many chase the highest returns without considering the risk of loss. Buffett's genius lies not in predicting the market, but in avoiding permanent mistakes. Losses, once incurred, are hard to recover. Gains, when combined with compounding, can multiply exponentially, but only if the capital survives. This mindset is what separates ordinary investors from legends. Buffett applied this rule throughout his career, from his early investments in undervalued stocks to acquiring companies like GEICO, Coca-Cola, and Sea Candies. He focused on value investing, buying businesses at a price lower than their intrinsic value. He didn't speculate, he didn't chase fads, and he didn't try to time the market. He bought assets that were durable, predictable, and manageable. By minimizing the potential for loss, he set himself up for enormous gains over decades. But this rule isn't just about money, it's a life principle. The idea of never losing translates to avoiding poor decisions in any area: career choices, relationships, and personal growth. Buffett teaches that success is built by protecting what matters, not by chasing temporary rewards. If you safeguard your resources, focus on fundamentals, and act with discipline, growth becomes inevitable. Buffett's ability to adhere to this rule also relies heavily on patience. While others were swept away by the dot-com bubble, housing boom, or speculative trends, Buffett stayed grounded. He waited for opportunities where risk was low and value was high. When the 2008 financial crisis struck, while many panicked, Buffett saw an opportunity to invest in strong companies at discounted prices. His adherence to Rule No One allowed him to make calculated moves when others were driven by fear. One of the most fascinating aspects of Buffett's approach is his circle of competence. He only invests in businesses he thoroughly understands. This principle reinforces Rule No One, because if you don't understand an investment, you increase the chance of mistakes. Buffett has repeatedly emphasized, it's better to pass on many opportunities than to invest in something you don't fully comprehend. Knowledge, patience, and discipline, all guided by the core rule, form the backbone of his strategy. Let's examine the psychological aspect of this rule. Most investors are swayed by emotions: fear, greed, envy, and impatience. These emotions lead to poor decision-making and costly mistakes. Buffett's rule acts as a safeguard. By constantly reminding himself to never lose money, he forces rational thinking. He considers downside risk before potential gains, evaluates the fundamentals rigorously, and avoids impulsive decisions. Emotional control becomes as important as financial knowledge in compounding wealth over time. Buffett also emphasizes the power of compounding, a natural extension of never losing money. If you preserve capital and allow it to grow consistently over decades, your wealth multiplies exponentially. He once compared investing to planting trees. The best time to start was decades ago. the second best time is now. But you cannot plant trees in soil that has been destroyed. Protecting the foundation capital ensures the fruits of compounding. Another critical lesson from this rule is the importance of value over price. Buffett doesn't buy based on what a stock costs today. He invests in businesses with lasting value. By focusing on intrinsic value and long-term potential, he minimizes losses and maximizes returns. He often says, "Price is what you pay, value is what you get." The rule ensures that you make decisions where value outweighs cost and mistakes are less likely to occur. Buffett's rule also applies to lifestyle choices. He lives modestly, avoids unnecessary extravagance, and focuses on what adds genuine value to his life. By limiting waste and distractions, he preserves energy and resources for what truly matters. This principle reinforces the idea that wealth is not about chasing the flashy or the immediate, but about safeguarding your foundation and making deliberate choices. Over decades, Rule No. 1 has allowed Buffett to take bold actions when opportunities arise. His investments in Coca-Cola, American Express, and Berkshire Hathaway itself were not driven by hype or trends, but by careful evaluation of risk and value. By avoiding losses, he created a platform from which he could capitalize on huge opportunities with confidence. This demonstrates that the absence of loss is a precursor to extraordinary gain. Buffett's approach also shows the importance of learning from mistakes. While the rule says never lose money, he acknowledges that errors are inevitable. What matters is that you minimize them, learn quickly, and protect your capital going forward. This disciplined learning mindset compounds over time, just like financial investments. Now let's translate this rule into practical lessons. First, always assess downside risk before chasing returns. Second, stick to what you understand and avoid speculation. Third, prioritize patience. Great opportunities are rarely urgent. Fourth, preserve your resources, whether financial, mental, or emotional. Fifth, allow compounding to work in your favor by making consistent, disciplined choices. Apply these principles in investing, career decisions, and personal growth. Buffett's life proves that success isn't about luck or chasing trends. It's about discipline, patience, value, and risk management. Rule No. 1 isn't just about avoiding financial loss. It's about building a framework for sustainable growth in every aspect of life. If you found this video valuable, hit the like button, share it with friends who want to learn from Buffett's strategies, and subscribe to the channel for more deep dives into the habits of the world's most successful investors. Comment below and tell us, which part of Buffett's Rule No. 1 will you apply first in your life? Your insights could inspire someone else in this community. The content in this video is for educational purposes only. It does not constitute financial advice or investment recommendations and does not guarantee any results. Always conduct your own research or consult a certified financial professional before making financial decisions.